welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Senior Analyst. So thankful to have you along. Happy Big Ten Championship Week to all of you who celebrate, unless you're in Ohio. No, I'm just kidding with that. And I guess even SEC Championship for you down there in Georgia. So exciting for sports people like Zach and I. This is our favorite part of the year for sports-wise. So enough of that. We'll flip over to the markets. We've got a couple of topics, both centered around interest rates, and we talk so often about them, but they're just so important to finance because it touches not only bond prices, but has its arms, and real estate prices can influence stocks and everything thereabout. So that's why it gets so much of our attention. This week we're not even going to talk only about the United States here, but look at Japan. And then the Fed rate decision coming up. So let's start in Japan, and really what I think is the most important chart in all of finance in the moment. So just for some context and some bigger background. So Japan really went through a 30-year cycle of fighting deflation, right? The opposite of what so much of the world has had in the last 5 years. They threw every single thing they could to keep from falling into deeper and deeper deflation. That is just a problem for which there is no cure, save for just throwing money at. As a result, they had interest rates, even on a 10-year treasury bond for them, a JGB, Japanese government bond, was hovering around 0% for much of the recent history. But that has begun to change. So when the world experienced some inflationary pressures, that also reached Japan, not quite as dramatic in other areas. But for them, any inflation was a change. And we've really seen interest rates there break out and move into what are essentially 20-year highs approaching 2%, something that hasn't been seen, say, for before the great financial crisis. So this trend is really significant for a couple of reasons. Number one, we live in a globally connected world. So you've got, as a major investor, an institutional investor, not only the opportunity to invest in the U.S. if you're looking for bonds, but you've got the Great Britain, you've got EU bonds all over the place, and Japan. So you've got choices for where to put your money. And for so long, people actually looked at Japan as the opposite. They looked at it as a place to borrow money and then take that and invest elsewhere. The official term for that is carry trade. And so when this begins to change, those are two major implications. Number one, it creates competition for bonds. So it kind of limits the amount that you could see our longer term bonds drop here in the US. And then two, it kind of puts pressure on this funding mechanism that has fostered a lot of investment throughout a lot of the world. So this is getting a lot of attention, and for good reason. It is interesting there. We've got a new regime in their government trying to do a lot of stimulus, and the market there pushing back against that somewhat. So as this unfolds, we'll have implications here in the US as well. But the trajectory and the slope of this certainly has investors' attention. So that's Japan, and really also will influence and at least have some thoughts for our Federal Reserve as they approach an interest rate decision here in the near term that Zach's going to give you some more context around.
Yeah, we have the next Federal Reserve interest rate decision on December 10th. So we'll look at this a couple different ways. First, we'll start with some of the comments from the voting members. There are 12 of them. And in order to reach a decision, they need a simple majority. So 7 of the 12 to vote either in favor or against a cut. Most often what you see is the vast majority of them vote in a certain direction. Then maybe you have 1 or 2 that dissent or vote against the direction that was decided upon. Based on recent comments, though, of the 12 voting members, we have 4 that appear pretty dovish, meaning that they tend to favor an additional cut on the 10th. We have 3, including Fed Chair Jerome Powell, that seem to sit somewhere in the middle. A lot of the comments they've made over the past month or so are hedging a bit. They're talking about how every meeting is live and there are no decisions made on the front end, but then they're made in the meeting. Talking about the economic trade-offs that could come with a cut or with a lack of a cut, and the need there to proceed slowly based on some of those economic trade-offs. And then as of right now, you have 5 that have made comments indicating that they're a little skeptical of an additional cut in December. Most of the hesitation from those 5 voting members are tied to inflation. Inflation as it stands, and really for much of recent history, has been above the Fed's 2% target rate. And so an additional cut being expansionary for the economy, their fear is that if inflation is not reined in, we could see that start to jump a little bit more if they continue to cut too aggressively. Notably, inflation data, the PCE, which is the Fed's preferred inflation metric, will come out 5 days before the next Federal Reserve decision. So our anticipation is that that data that is released on the 5th will have quite a significant impact, particularly for the 5 that appear more hesitant right now, and then in addition to the other 3 that are kind of on the fence as it stands. The chart you have on your screen, though, is the market's anticipation. This is based on futures traders in the interest rate market. The market is pricing in right now an almost 88% chance that we will see an additional 25 basis point cut. So while looking at some of the comments from the voting members, there seems to be quite a split in terms of which direction we'll head. There's a lot of uncertainty. If you look at what the market is expecting and how they're pricing the coming decision, it seems pretty likely that we will see another 25 basis point cut on the 10th. But again, a lot of that predicated on inflation data that will be released just prior to that.
Yeah. Well put, Zach. And we've got just really a massive dump of data coming in, and not just inflation, but other numbers as well. So it'll be interesting. The market could have a lot of digesting to do, but usually we just look no further than where the market is pricing things ahead of time. It usually has a good feel. So thank you for that update. And thank you to all of you for giving us this time. We sure do appreciate it. If we can be of service, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thank you and have a great weekend.